this audiobook expects to accomplish. The purpose of this audiobook is to supply, in a form suitable for laymen, guidance in the adoption and execution of an investment policy. Comparatively little will be said here about the technique of analyzing securities. Attention will be paid chiefly to investment principles and investors' attitudes. We shall, however, provide a number of condensed comparisons of specific securities, chiefly in pairs appearing side by side in the New York Stock Exchange list, in order to bring home in concrete fashion the important elements involved in specific choices of common stocks. But much of our space will be devoted to the historical patterns of financial markets, in some cases running back over many decades. To invest intelligently in securities, one should be forearmed with an adequate knowledge of how the various types of bonds and stocks have actually behaved under varying conditions, some of which at least one is likely to meet again in one's own experience. No statement is more true and better applicable to Wall Street than the famous warning of Santayana. Those who do not remember the past are condemned to repeat it. Our text is directed to investors as distinguished from speculators, and our first task will be to clarify and emphasize this now all but forgotten distinction. We may say at the outset that this is not a how to make a million book. There are no sure and easy paths to riches on Wall Street, or anywhere else. It may be well to point up what we have just said by a bit of financial history, especially since there's more than one moral to be drawn from it. In the climactic year 1929, 5% in the price level of leading common stocks, ending in May 1970. This was the highest percentage decline in some 30 years. Countless issues of lower quality investor under today's conditions. But next year, or the years after, may well be different. We shall accordingly continue to devote attention to the possibilities for enterprising investment, as they existed in former periods and may return. It has long been the prevalent view that the art of successful investment lies first in the choice of those industries that are most likely to grow in the future, and then in identifying the most promising companies in these industries. Few years, and on many similar occasions before, were realized in those common stock issues where the buyer forgot to ask how much. In June 1970, the question how much could be answered by the magic figure 9.4%, the yield obtainable on new offerings of high-grade public utility bonds. This has now dropped to about 7.3%, but even that return tempts us to ask, why give any other answer? But there are other possible answers, and these must be carefully considered. Besides which, we repeat that both we and our listeners must be prepared in advance for the possibly quite different conditions of, say, 1973 through 1977. We shall therefore present in some detail a positive program for common stock investment, part of which is within the purview of both classes of investors, and part is intended mainly for the enterprising group. Strangely enough, we shall suggest as one of our chief requirements here that our readers limit themselves to issues selling not far above their tangible asset value. The reason for this seemingly outmoded counsel is both practical and psychological. Experience has taught us that while there are many good growth companies worth several times net assets, the buyer of such shares will be too dependent on the vagaries and fluctuations of the stock market. By contrast, the investor in shares, say of public utility companies, at about their net asset value, can always consider himself the owner of an interest in sound and expanding businesses, acquired at a rational price, regardless of what the stock market might say to the contrary. The ultimate result of such a conservative portfolio policy have been emphasized, the purchase of high-grade bonds, plus a diversified list of leading common stocks, which any investor can carry out with a little expert assistance. The adventure beyond this safe and sound territory has been presented as fraught with challenging difficulties, especially in the area of temperament. Before attempting such a venture, the investor should feel sure of himself and of his advisors, particularly as to whether they have a clear concept of the differences between investment and speculation, and between market price and underlying value. A strong-minded approach to investment, firmly based on the margin of safety principle, can yield handsome rewards. But a decision to try for these emoluments, rather than for the assured fruits of defensive investment, should not be made without much self-examination. A final retrospective thought. When the young author entered Wall Street in June 1914, no one had any inkling of what the next half-century had in store. The stock market did not even suspect that a world war was to break out in 2 months, and close down the New York Stock Exchange. Now, in 1972, we find ourselves the richest and most powerful country on earth, but beset by all sorts of major problems, and more apprehensive than confident of the future. Yet if we confine our attention to American investment experience, there is some comfort to be gleaned from the last 57 years. Through all their vicissitudes and casualties, as earth-shaking as they were unforeseen, it remained true that sound investment principles produced generally sound results. We must act on the assumption that they will continue to do so. Note to the listener: this audiobook does not address itself to the overall action. If you have built castles in the air, your work need not be lost. That is where they should be. Now, put a chronicle of calamity. Now let's take a moment to look at some of the major financial developments of the past few years. 1. The worst market crash since the Great Depression, with U.S. stocks losing 50.2% of their value, or $7.4 trillion, between March 2000 and October 2002. 2. Far deeper drops in the share prices of the hottest companies of the 1990s, including AOL, Cisco, JDS Uniphase, Lucent, and Qualcomm, plus the utter destruction of hundreds of Internet stocks. 3. Accusations of massive financial fraud at some of the largest and most respected corporations in America, including Enron, Tyco, and Xerox. 4. The bankruptcies of such once glistening companies as Conseco, Global Crossing, and WorldCom. 5. Allegations that accounting firms cooked the books and even destroyed records to help their clients mislead the investing public. 6. Charges that top executives at leading companies siphoned off hundreds of millions of dollars for their own personal gain. 7. Proof that security analysts on Wall Street praised stocks publicly, but admitted privately that they were garbage. 8. A stock market that even after its blood-curdling decline seems overvalued by historical measures, suggesting to many experts that stocks have further yet to fall. 9. A relentless decline in interest rates that has left investors with no attractive alternative to stocks. 10. An investing environment bristling with the unpredictable menace of global terrorism and war in the Middle East. Much of this damage could have been, and what almost invariably leads to disaster. By letting themselves get carried away on internet stocks, on big growth stocks, on stocks as a whole, many people made the same stupid mistakes as Sir Isaac Newton. They let other investors' judgments determine their own. They ignored Graham's warning that the really dreadful losses always occur after the buyer forgot to ask how much. Most painfully of all, by losing their self-control just when they needed it the most, these people proved Graham's assertion that the investor's chief problem, and even his worst enemy, is likely to be himself. The sure thing that wasn't. Many of those people got especially carried away on technology and internet stocks, believing the high-tech hype that this industry would keep outgrowing every other for years to come, if not forever. In mid-1999, after earning a 117.3% return in just the first 5 months of the year, Monument Internet Fund portfolio manager Alexander Chung predicted that his fund would gain 50% a year over the next 3 to 5 years, and an annual average of 35% over the next 20 years. After his Amerinido Technology Fund rose an incredible 248.9% in 1999, portfolio manager Alberto Villar ridiculed anyone who dared to doubt that the internet was a perpetual money-making machine. If you're out of this sector, you're going to underperform. You're in a horse and buggy, and I'm in a Porsche. You don't like tenfold growth opportunities? Then go with someone else. In February 2000, hedge fund manager James J. Cramer proclaimed consistently in good days and bad. Cramer even took a pot shot at Graham. You have to throw out all of the matrices and formulas and texts that existed before the web. If we use any of what Graham and Dodd teach us, we wouldn't have a dime under management. All these so-called experts ignored Graham's sober words of warning. Obvious prospects for physical growth in a business do not translate into obvious profits for investors. While it seems easy to foresee which industry will grow the fastest, that foresight has no real value if most other investors are already expecting the same thing. By the time everyone decides that a given industry is obviously the best one to invest in, the prices of its stocks have been bid up so high that its future returns have nowhere to go but down. For now, at least, no one has the gall to try claiming that technology will still be the world's greatest growth industry. But make sure you remember this. The people who now claim that the next sure thing will be healthcare or energy or real estate or gold are no more likely to be right in the end than the hypesters of high tech turned out to be. The silver lining. If no price seemed too high for stocks in the 1990s, in 2003 we've reached the point at which no price appears to be low enough. The pendulum is swung, as Graham knew it always does, from irrational exuberance to unjustifiable pessimism. In 2002, investors yanked $27 billion out of stock mutual funds, and a survey conducted by the Securities Industry Association found that 1 out of 10 investors had cut back on stocks by at least 25%. The same people who were eager to buy stocks in the late 1990s, when they were going up in price and therefore becoming expensive, and by definition became cheaper. As Graham shows so brilliantly in Chapter 8, this is exactly backwards. The intelligent investor realizes that stocks become more risky, not less, as their prices rise, and less risky, not more, as their prices fall. The intelligent investor dreads a bull market, since it makes stocks more costly to buy. And conversely, so long as you keep enough cash on hand to meet your spending needs, you should welcome a bear market, since it puts stocks back on sale. So take heart. The death of the bull market is not the bad news everyone believes it to be. Thanks to the decline in stock prices, now is a considerably safer and saner time to be building wealth. Listen on, and let Graham show you how.